Hello and welcome to another edition of Wealthy and Wise. I'm your host, Court Christie, and today we're going to be talking to flippers, those people that flip real estate. That's buying and selling real estate, buying, renovating, and then selling the real estate. But there's some things that you need to know if you are a flipper. You need to know what's the right business entity to use. You need to know what's the right way to be taxed. There are some things that are tricky that if you don't get it done right, you may end up with some big tax problems. And so in order to help me unwrap this, I have brought an expert in, David Chafgar. David Chafgar is one of the premier experts at NCH who's been working with clients in real estate investing for over 20 years, and he's just a superstar. Our clients love him, so I want to say thank you and welcome, David.
Thanks for having me, Court. It's always a pleasure.
Absolutely. So I'm glad you're back with us today, and you've had a chance to talk to me before on different subjects, and I know we deal with a lot of real estate investors. They love Nevada because they know that their valuable asset, that real estate asset, is going to be protected from any kind of litigation or issues that might ever come up, and they have a safety net basically around that asset. But the real estate investors that are wanting to come to us, not just to buy and hold the property and rent it, but to make money at, hopefully finding a great deal, putting a little bit of lipstick on it and flipping it and selling it to make money, there's some considerations that they need to have. Let's start with, what's the right business entity for them to use?
Yeah, that's always a good question. I mean, there's so many different business entities out there that you can choose from, and sometimes trying to figure out what's the right one for me can be a little bit daunting sometimes. But at the end of the day, there's, fortunately, in the real estate investment world, there's very specific entities that have been utilized for the last 15, 20 years by individuals that have been in real estate. Commonly, what you're looking for more if you're going to be flipping properties, you're looking for something that has a corporate election. I think the most common U.S. entity used is LLCs. We use LLCs to hold rentals. We use LLCs to flip properties, buy, rehab, sell, or wholesale. The S-election, commonly, we talk a lot about with clients that we work with, because the S-election provides just a tremendous amount of corporate deductions, write-offs, better tax strategies, better ways to reduce self-employment taxes. As we all know, taxes are one of the largest bills we ever have in our lifetime, and we have to find ways to reduce that. And, LLCs with an S-election, I think is probably the best entity to use if your goal is to really focus on, flipping properties more so.
Okay, fantastic. Yep. And, we form thousands and thousands of business entities for real estate investors, for active businesses. And, I would say based on, the data that we have, probably 90% of our clients are using LLCs versus corporations or nonprofit entities or limited partnerships, which are some of the more common legal entities that we work with. But then when we start getting into, the tax election, now we start getting into the nitty-gritty of, where things can go wrong if you don't do it right. And you want to get it done right at the beginning of the process. You don't want to make these mistakes later on because it'll cost you a lot. And so that's where it's critical. So talk to me about, first of all, the tax selection and how do you want to be taxed as a flipper?
Yeah, that's always a good question, a common question we get asked a lot about. The thing you want to consider, especially if you're going to be flipping properties, is, the type of income you are going to be recognizing. Because in real estate as an investor, there's two primary types of income that, most real estate investors recognize. One referred to as passive income, the other, of course, active income. Difference between passive and active is typically how long you actually hold the property. Passive is essentially any properties that you buy and hold beyond a year. That's what we call long-term. Short-term is going to be more like your wholesale, rehab, and flips. Essentially the other side of that coin, any properties that you buy and sell in under a year. And because of the time frame, most individuals that are flipping properties, whether it's wholesale or rehab, those are going to be short-term transactions. I buy a property today, I put some paint on it, and I flip that property within 2-3 months, which is short-term. And because of that, that's recognized as ordinary business income. Now, because of that, tax rates, you have to remember, are going to be more on the ordinary business income side, tax rates can start out when you factor state and federal, as low as 22 to 23%. But throughout the year, depending on how well you do, let's say you go out and you have a banner year in business, those tax rates can increase sometimes to well above 40 to 45%. So they can actually get really high. Now, of course, if you're getting to the 40, 45% tax bracket, that just means you did really well. Making millions of dollars in your business, which that's the ultimate goal, right? But I think it doesn't matter how much money you make. Nobody wants to pay 40%. So, as investors in real estate, especially those are focusing on short-term or active or flipping properties, what you're looking for is a tax model that gives you advantages, ways to reduce your tax rates. So if I do get up to the, higher tax brackets, I want to be able to use the corporate deductions, write-offs to be able to chip away at the 40% at the end of the year. That way I'm not paying taxes at that level, and we can use those corporate write-offs to now bring that tax rate down, hopefully to a more manageable rate, maybe 23 to 28%. That way you're putting that 10, 15% difference back in your pocket, versus what you're giving away to those darn tax boards each year.
Interesting. So, in a traditional business, you start earning income, and you've got your expenses. Maybe
Right.
hire some staff. Are flippers? Do they have to pay themselves salaries? Do they have to take any payroll out of the business? Is there a requirement for that?
Commonly, the first year, the IRS gives you a little bit of flexibility there. But commonly, if you're operating under a corporate, election, the IRS does like to see that you do have employees in the company. Now, keep in mind, you may be the only employee that you have. I may be the owner of the business, and I may be the only employee of the business. But still, there's going to be a lot of advantages using that S election. So commonly we would create an LLC, we would file an S election, so it's treated very similar to an S corporation, and that allows me then to take advantage of a lot of those corporate deductions that I can benefit from. And lowering self-employment tax is huge. It's a big tax savings when I can lower it another 10, 15%. That just means, again, more money in my pocket, each and every year. But yeah, those are considerations that you want to make sure you are talking to your tax professionals about, because, there's certain things the IRS does like to see, but we can sort of fix that along the way, depending on how we structure your business and, and really what election we use.
Mm-hmm. Okay. So important to know, what type of income you're earning.
Right.
This is ordinary income. It's not long-term capital gains. It's going to be treated at some of the highest tax rates that we have. And, I think as flippers go, to use the S election, which is so important in the process here, because there is some tax minimization strategies by being an S elected entity that then affords itself to other things that can come up. Like, for instance, let's say that I was an active flipper, David, but I also recognize that there's some heavy taxes in ordinary income. Are there other ways of deferring some of that taxes? Like, could I set up retirement plans for myself?
Yeah, that's a great question. That's another benefit of really using a proper election, even more like a corporate model or an S election. It affords you or gives you the ability to actually utilize, retirement planning as a way to defer or lower your all tax consequence or liability. Imagine if I'm making, a couple $100,000 in my business. Normally that's income that I have to take. Now I've got to pay state and federal on it, just like, anyone else would. And maybe, I'm starting this business out for the first time. So maybe I have other income. I'm working full time for corporate America. I have other investments that I'm generating income from. And I really don't need the $200,000 I just made. It's nice to have it, but I also know if I take it, I'm going to have to pay taxes, on that income. So if you have a good CPA, one of the strategies a lot of CPAs will share with you, they'll probably yell in your ear, defer, defer, defer. Take as much of that 200 grand as you can if I don't need it, and try and defer it to a retirement account. Put it away in retirement, which then not only allows you to increase your retirement, ultimately putting money away for, your retirement, your future. But remember, anything that we defer now also is taken off the top so that we're not having to pay taxes on it that year. And depending on what type of retirement account, I talk a lot with clients about using something called a solo K that can be very beneficial because it can allow you to contribute upwards of $60,000 to $70,000 a year, depending on age. Imagine now that 200 grand that I normally have to pay taxes on. What if I was able to take maybe 60,000 of that, make it as a contribution to my retirement that year? Well, that means at the end of the year, I'm no longer having to pay taxes on 200. Now that defers it down to paying taxes on only now 140,000. If you factor roughly about a 30% state and federal tax rate, that's a pretty big tax savings. That could be $18,000 to $20,000 a year in tax savings that you were able to put away. That's money that you would have paid taxes on no matter what, that I now got to keep. And that again went to, increasing my retirement. And of course, there's strategies that can give you the ability to even utilize it if that retirement account is self-directed to really help you even more so as an entrepreneur and business owner.
And I think so many people that are listening start thinking about, okay, retirement planning, using my real estate investment gains or profits. Why would I do that? Why wouldn't I just take the profits and keep rolling them forward and buy the next property? And the thing that you're pointing out that's so important that oftentimes people don't think about when it comes to retirement planning is you can still do that. Mm-hmm. You can still roll that. And I want you to talk about how to use your retirement money for buying additional real estate. But before I do that, I want to point out to the audience that when it comes to retirement planning, the whole idea is if you can minimize the taxes that you're having to pay today by taking a chunk of the income, or profits in this case, and moving them into a period of your life where you're going to be earning a lot less money. Mm-hmm. Now we're talking about those retirement years. Everyone has a plan. Now maybe you enjoy work, you're just going to work till you drop dead. Mm-hmm. Most people are going to cut back at some point in time. They're either going to be forced to because of health or other reasons, but you will be making less money at some point in time. And all of us know we can't rely on Social Security for our future, our income forever. So we have to be planning ahead. So what happens is you move some of that money into retirement plans, then you start taking it out once you're earning Social Security, where that's your only real income, and then you start to tap the retirement money that you've set aside, and you're paying less taxes or a lower percentage than your high income earning years. And during the high income earning years, you want to prepare for the low income earning years by deferring some of that and pushing it out further. You still make the money, you just don't pay the tax. So now let's talk about how you can use that retirement money, David, in additional real estate investment. How does that work?
Yeah, those are, when you figure out ways to really leverage the retirement dollars that you are putting away for your future, because that's really what we're doing, right? We're putting money away so we're not having to go back on Social Security and try to support ourselves through those, with just that type of income. But, as an entrepreneur, as you're putting money away, many times you find yourself in a situation where you run across another property, you find another investment that could be a great opportunity to make some additional income. And, a lot of times we have all this money in a retirement account, and, normally if it's a standard 401k or IRA, many times I can't touch that money once I put it away, at least without major taxes and penalties in most cases. However, there is what they refer to as self-directed vehicles. I mentioned something referred to as a solo K, which is essentially an individual 401k plan. Imagine now being able to contribute in the same manner to a solo K, and all the monies I'm contributing, 50, 60,000 a year that I'm putting away, I can now, if I find other investments or other investment opportunities that I can really benefit from, imagine now being able to tap into it, whether it's I'm borrowing money from my own retirement account, if I have the ability, something referred to as power trustee, I can authorize myself a personal loan to take money out to put towards those investments, or I can actually contribute that money directly in as a retirement investment. Whether I'm buying a rental property or in the case of flipping, imagine I find a property that I need, let's say $200,000, $150 to buy it, $50,000 to renovate it. Commonly, a lot of individuals that are flipping properties will use like a hard money lender, private money lender, and commonly in the US they cover on average 75, 85% of project costs. So if I need 200 grand, They might write me a quick check for about $160,000 to put towards that cost, which is 80% of that 200. And then I, as the investor, are now responsible to cover the remaining 20% difference. It's what we refer to as gap funding, the difference between what the lender covers and what we still need to complete that transaction. So now as an investor, this is a property that I can make a lot of money on if I'm able to rehab and flip it. I've got a hard money lender covering the 80%. Now I'm scrambling around to try to cover that 20%. In that example, maybe it's the difference of $40,000. Maybe I don't have that in my bank account. Maybe I don't have enough credit available to tap into. One of the advantages of using a properly structured retirement plan like a Solo K is it now gives me the ability to go into it. Imagine I authorize myself a personal loan for $40,000. So happens to be the difference between of what I need to complete that transaction. So again, hard money covers the first 160. I borrow the other 40,000. Now I have the 200,000 I need. Now I can buy that property. I can renovate the property. Maybe a few months later, once the renovation is done, I'm now going to list it. I'm going to sell it. Maybe I sell it for 280. Or 260, 280. Make a quick 60, 80,000 on that flip. Well, the nice thing is the only requirement on this type of vehicle, as long as I pay that loan back, remember I took a personal loan, requirement is that I've got to pay it back. So now upon sale of 280, I pay off my hard money lender, give them back the 180, 190 with interest. I take the 40,000 that I borrowed from my retirement account, and now that leaves me 50,000 left over. Well, once my retirement account has been paid back, now that allows me to take that additional profit, that 50, 60,000 in profit, and now I can put that directly into my pocket to recognize as income that year. So what I'm doing is I'm leveraging my own retirement account, essentially becoming my own private lender. So I'm leveraging it in a way, where that I can borrow it, use it to actually generate income for myself. It's a pretty powerful tool. There's a lot of great strategies you can leverage.
Oh, that's fantastic. So flippers can really do a lot of tax minimization if they understand some of the tools that are afforded them, like the difference between an S election and, for instance, a disregarded entity, which many people use as LLCs, where they just file it on their personal tax return, and you'll be losing some opportunities by doing it that way. You want that S election, or taking advantage of the, having a self-directed 401k plan, allowing you flexibility to be your own banker, or after enough years of putting money into, your own solo 401k plan, you'll have enough to actually buy a property in the plan. Just like all of us are invested in mutual funds or investments or ETFs in our retirement accounts. You could just buy a property with your own retirement plan and let that income grow inside that retirement plan and utilize that. That could be the next level of it at some point in time as enough money gets accumulated. So I like the idea of being your own banker with your retirement money. And, basically it's money that you paid zero tax on. You will pay tax on it at some point in time in the future, but zero tax on it, allowing you to leverage all the hard work you do. Let's say you're out there, you flip 2 homes in a year and you have 2 good ones. And let's say they're both $100,000 in profits, right? Solid deals, you made great money, you've got $200,000 of profits. Now you're going to have to pay the piper, you're going to have to pay taxes. Most of you have day jobs in addition to, thinking about flipping homes. And so now you're going to have that income combined with your new, flipping income. You're going to pay a ton in taxes. So think about the best way to do it. Learn from the expert, David Shafgar. He's amazing. David, thanks for filling us in on some of your great strategies. There's a lot more that David has to offer too. And if you ever want to sit down with David and talk to him about the strategies that you have, just simply reach out to NCH. We'd be glad to take care of you. Ask for David specifically. He's a genius when it comes to working with small business owners and real estate investors. And set up an appointment with him, talk one-on-one. It doesn't cost you anything. He'd be glad to talk to anyone and to really help him out. And David, thanks for being on the program
today.
Thanks
for having me.
Absolutely. And for all of you tuning in to another edition of Wealthy and Wise, I want to say thank you so much. And please be sure to like and subscribe. We need the feedback and we need to continue to spread the message. So thank you for tuning in.